Now, as the COVID-19 pandemic does continue to inflict damage in East Africa's largest economy, ABSA's Kenyan subsidiary has restructured about 15% of its near $2 billion loan book. That amounts to roughly 30 billion shillings, about $283 million worth of loans, whose terms have been extended as cash flow among individuals and enterprises declines, or in some cases, like the tourism sector, disappears entirely. The bank reported a 12% year-on-year rise in its loan portfolio for the first quarter of 2020. Interest income from that was relatively flat, just under $52 million. Net earnings for the quarter rose by 1.8% to about $17.3 million. Now, the bank did hold over $770 million worth of government debt on its books at the end of the quarter. When I spoke to the ABSA Kenya managing director a few hours ago, I asked him if the bank had been formally approached with a proposal to defer interest payments on some of the government bonds in its portfolio.
I can say for us as ABSA, we've not been asked to push out interest payments or to accept interest payments at a future date. I know these ideas have been proposed. The Actuarial Society suggested that the payments be pushed out. And so the worry that I have is if you push that out, and government securities are a fairly significant proportion of the funds and the investments that those funds have made, that you could end up creating real problems for pensioners. And those are the very people, they live off their pension, so I'm not sure how viable really it is for us to continue this. And the other thing is it could also be deemed as a potential default if they're unable to make those payments. So I think going down that route, there may be other unintended consequences that could impact the pricing of government debt in the future.
The KBA Housing Index has pointed out that house prices have now been falling for at least 5 quarters in a row. Not by much in every single quarter, but it's been sustained as far as trends are concerned. Your mortgage market exposure is relatively small, but what sort of stresses are you seeing coming up in the housing market?
I mean, I think, the one thing is that most people, the first payment they'll make is their mortgage repayment. So people have mixtures of debt. They'll have maybe a mortgage, they'll have an unsecured loan, maybe they have a credit card. So typically your stress you would expect to experience is maybe on your credit card, on your unsecured loan. But the mortgages, people generally will want to make sure they pay because they don't want to get into default and end up losing their property. I think in general, because of the environment, and I think it's more the uncertainty of the future environment, people are just sitting on the sidelines waiting to see how badly is this economy going to be hit, what prices are these assets going to be in the future. So you don't want to jump in now and then find housing prices are dropping, impacting your potential purchase price. So I think that could be more a function of supply and demand. And then you've got the sellers on the other hand saying, now isn't the ideal time to sell my property. So I think it's all those factors, but we haven't seen huge strain yet, at least in the short run. But our portfolio may not be fully representative of the entire mortgage market.
About 8%. Your dividend yield was the second highest, I believe, last year in the market among Kenyan banks. What's the thinking? I know this is a board level decision, but what's the thinking at the moment around paying out dividends this year? Because as you mentioned, there's a lot of uncertainty around how the economy will evolve, where the job market is heading, and how businesses will generally perform. It would be prudent in this market to hold on to cash, but shareholders may not necessarily see that argument.
Yeah, I mean, I think this is a very topical subject. I'd say a number of things. I think the first is that banks are businesses like any other. And I think people sometimes forget that. Banks they're not wholly responsible for underwriting the economy. So when they're looking at how they run their banks, as directors of banks, you have a fiduciary responsibility and a duty of care to protect the bank's assets, to protect the deposits of customers. So banks have to hold that capital in line with regulatory requirements. So if we start having much greater delinquency, much greater default and impairment, that starts eroding your capital base. Thankfully, I think for our market here in Kenya, our capital adequacy levels at the total capital level are sitting north of 17%. But we would expect through this crisis, it's inevitable impairments are going to increase, that capital number will start dropping down. So depending where your bank's capital adequacy levels are, they may see it prudent to retain capital to shore up their capital positions. Their capital also that they keep is also dependent on the risk-weighted assets they're going to book in the future. So if they don't see a big upswing in assets, they could maybe hold their capital levels correctly. But I think banks obviously need to manage risk. So the fact that you've seen a number of bank boards decide to hold back capital, I think just really shows prudence. But each bank has to make its decision around whether to pay dividends. So I think you can expect to see, banks and institutions looking at what are their payout ratios to make sure that they come out strong and survive this crisis in a way without additional stress. It won't be easy for them to go and get new capital. If they've paid out the dividends, you run into capital problems, then you have to go back to the market. It's expensive, and you're probably going to have to go either through a rights issue or through going to tier 2, and that tier 2 could also be unpredictably more expensive than your tier 1 capital.